Thank you for your time today to take this interview. And I guess officially I'm the co-founder of Market Monkey, which is a growing community of active investors. And we really are a growing interested body that I would say we fall somewhere between a trader and a long-term investor, and looking at new directions in investing that perhaps have been previously underutilized by the average investor. And we have certainly been following your work, Daryl, with interest. And I know that you probably have a pretty huge following of traders, probably day traders and traders all over the world. But I imagine you also have a big following of investors as well. So we're really interested because we have shared your work with our community, particularly.
Thank you.
And we would obviously want to share your work further and your works as well. So we'll talk more about that during this interview, if that's okay. But obviously we really want to really share some of your insights, which I think are very underutilized in investing and perhaps are more common concepts in investing, trading circles. And so we have some questions for you today, and hopefully you can share some of your wisdom and experience with us. So thank you very much. So Daryl, welcome, and obviously we're very thrilled to have you join us today. And there are probably many people that are unfamiliar with your incredible journey, and obviously you've dedicated, decades to mastering financial markets, and also helping people understand those better. And so particularly we were very excited to discover when we were reading more about you that you are based in Darwin. And I just wonder how you balance the tranquility of the outback with the fast-paced nature of the trading markets.
I simply ignore the fast-paced nature of the trading markets. So I suppose it would be fair to say that there are three categories of people who are involved in the market. The term trader really should be split into two groups. There is, of course, let's call them the day trader or the short-term trader, momentum-driven, looking at trades that are lasting 2 to 3 days. That's not where I work. There are traders in the sense that I might hold a position for 3 or 4 weeks, 3 or 4 months, as long as it continues to make money, as long as it continues to meet those conditions that keeps the trade open. And that's not investing. Investing is taking a gamble in the market, because typically what happens with investing is that you've made a decision. We'll take ANZ Bank as an example, or Combank. You've made a decision that this is a good investment. So you will hold it through ups and downs, irrespective of what happens. So you take a bit of a gamble that your view of that particular stock is better than or more informed than the market. Good luck to you in that sense. But from my perspective as a trader, not as an intraday trader, but as a trader, my objective is to make my capital work as efficiently as possible. So that means that while the stock is going up, I'm happy to ride with it. But once it starts to retreat, and I have a set of conditions that tell me, look, I think it's time to get out of this stock, I'll jump out of that stock. It might be 3 weeks after my entry, it might be 3 or 4 months after my entry, and then I'll re-enter as the trend reestablishes itself. So I'm making no claim at all that I know what's likely to happen, that my analysis is better than your analysis, that my understanding of the company is better than someone else. I'm simply, to use a term, in it for the money. I'm getting the best return possible on my capital compared to alternative uses. And that may be putting it in a bank deposit, it may be putting it into a housing market, any other type of investment vehicle.
Wonderful. Yeah, so it's really interesting. I think so many people say, what is the difference between an investor and a trader? And you've sort of made a few distinctions there. Do you think the definition of that has changed over time?
It goes back, yes, it has changed over time. It's an artificial distinction. What tends to happen is that there's a great deal of time and effort required to do fundamental research. Essentially, the fundamental researcher is saying, I know more than the company accountant. I know more than the company board, and I make better decisions than the company CEO. There's a bit of arrogance involved in that, but that's what it's all about. So we take the figures that are being produced, which are, of course, rearview mirror figures, and we think that we can interpret them more effectively than the company directors. I don't think that's a valid stance, but people do that. That's what underpins it. And then come along these nasty chartists and technical analysts who look at a chart and say, oh, we think this is the price target. I remember doing a presentation in Singapore, and there was myself and there was a gentleman from one of the major brokerages. And I was taking questions at the end of the event, and we brought up the chart, and I was asked to analyse it and produce some price targets and so on, which I did. I hadn't seen the chart before, looked at it, yes, right, this is where the potential price target is, etc., etc. And my co-presenter, as it were, shook his head and said, you did that in 2 minutes. It took us 2 months to reach the same conclusion. So part of what the conflict, for a better word, between those who use charting and technical analysis techniques and those who use fundamental techniques, on which most of the brokerage industry is based. If I can reach a conclusion faster and more rapidly than using fundamental techniques, then I'm a threat to that particular industry and that particular industry model. So we do tend to get put into broom cupboards, as it were, and lots of talks about reading tea leaves and it's witchcraft, etc., etc. That's changing a bit. And even now you find that some of the fundamental brokerage analysts are using technical analysis as well.
So you really think there's a bit of a shift from the two camps into some blurring in between sort of charting and the fundamentals of company analysis? Oh,
of course there is. And that's inevitable. The divisions are not as strong as they used to be. And although I'm well known, perhaps best known for my work with technical analysis and charting, yes, we do use some fundamental analysis. Not particularly well, I might add, but we do use it. So, in fact, I was just writing recently, my working assumption is that everyone else in the market knows a great deal more than I do. So when I look at brokerage reports, at specialist newsletters that are based on fundamental analysis, I don't immediately dismiss them, not at all. There's a lot of work and research that's gone into that. That's great. However, the conclusions that those analysts reach is often not particularly useful for either a trading or investment perspective. So, for instance, I was looking at a recommendation for CSL recently. Have one look at the chart. CSL is in a tremendous nosedive. At some stage in the future, it'll begin to recover, and that'll be a good entry point. But to recommend it as a buy, as an investment at this point in time, the chart analysis would say, no, you're much better off waiting for another 3 or 4 or 5 or 6 or 10 weeks, however long it takes, until there's a pattern of behaviour that shows you that that downtrend has ended. The fundamental analysis doesn't change, but the technical analysis helps you to identify a more effective entry point, and that's the key. Now, whether your purpose is to trade that stock or to invest in that stock, a better entry point will give you a better result. There's no question.
And I guess, is that sort of, people talk about time in the market and timing the market. I guess, would you say investors historically have had that time in the market, but as you're saying, you could read the fundamentals, but also timing the market, is that what you're saying, is also important? So
no one, unless they're very lucky, is going to pick the very bottom or the very top of the trend. And it's perfect to suggest that that's what traders and technical analysis is all about. It's not. But there are clear signals or conditions that will identify when a downtrend has a higher probability of turning into an uptrend. Okay, I'm quite happy to time my entry to take advantage of that turn in the trend. I might be a little early, I might be a little late, but that's a much better solution to me rather than buying it and hoping that sometime in the future it might possibly turn up, because the longer I hold the stock, then the better the chance is that it's going to reverse its trend. And that's very much a fallacious thought. I can give you many examples, and you can identify them themselves, where you can buy a stock and hold on to it for 2 or 3 or 5 or 6 or 7 or 8 or 9 or 10 years, and it still doesn't get above your entry point. So whether you're investing or trading, you have to make a decision about how much you're prepared to lose before you admit that your analysis, your entry point, was incorrect. And although we can say there's a simple answer to that, the reality is that the answer depends on a whole range of other external factors as well. So yeah, I mean, I hold stocks that I should have sold ages and ages ago. And for some of those stocks, I hold them for, let's call them, moral purposes. I have a belief in the company that what it's doing is trying to do something good. So you're talking, for instance, about spray on skin and those types of things. Yeah, I'm happy to support that company in its endeavours. My objective in taking that investment is not to make money, but to support the company in what it's trying to do. But they're few and far between, let's hastily add. So when we come to the market and invest, yes, technically we're looking to make money, but there are also other objectives that are involved. Having said that, to come back to your original question, time in the market is not an antidote to stupid decisions. Timing the market is never an exact science, and no one pretends it is. But with even basic analysis, you can make a more effective entry decision, so you're not riding the thing further down. Yes, you may miss some of the initial profit. That doesn't matter. If you believe that the trend is going to continue strongly, a slightly delayed entry is neither here nor there.